Hey guys, and welcome to our latest video. Today we're going to be talking about covered calls, various covered call strategies. We're going to go through some examples, and then we're going to talk about the risks involved. I know some of you have been waiting quite some time for this video to come out. I'm sorry about that. My focus is still primarily going to be on the streaming channel. It's going to be on day trading. It's going to be on research into these stocks and assets live. And I hope to build this as a repository for knowledge that people can reference in the future, or for new traders just entering the market or just tuning into the live stream. So I'm sorry that the videos have been slow in coming out, but there will be more of them over time. Just bear with me. Anyway, on to the subject at hand. Our first option strategies video. Today we're going to be covering covered calls or buy rights. So what is a covered call? If you remember from our first video, a call option is a contract that gives the right of the owner, but not the obligation, to purchase 100 shares of the underlying stock at the agreed upon price, strike, by the agreed upon date, expiration. A covered call represents a natural bridge between stock investing and options. They are considered one of the simplest option strategies and one of the least risky. A covered call is sold by someone who owns 100 shares of the underlying stock. By owning the underlying asset, the call writer, or seller, avoids the risk associated with writing naked calls, which have an infinite loss potential. Effectively, I, the writer, will enter an options agreement with you, the buyer, to give you the right to buy 100 shares of my stock at the agreed upon price, strike, by the agreed upon date, expiration. And in return, I will receive a premium paid to enter this agreement by you, the buyer. Calls can be secured with convertible securities as well. Things such as bonds or preferred stock, warrants, and even leaps, which are a longer dated type of long call contract. So why use covered calls? Well, stock ownership presents risk. Writing calls allows a stock owner to collect premium and dividends on their investment, reducing exposure to volatility in the underlying asset. So by profiting off of the thing that you already own, you can reduce or offset losses that you may experience in the short term on your long position in a stock. The objective of a covered call buy right strategy is to maximize returns on stock ownership through premiums, dividend income, and also improvement in price in the underlying stock. A call writer will see better returns than a pure buy and hold strategy if the underlying stock goes up slightly, remains neutral, or drops slightly. A writer would want to be slightly bullish or neutral on the underlier, as the stock must be held to secure the contract. Here is an example of a covered call chart. As you can see here, regardless of the increase in the price of the stock, the maximum premium plus the strike price is the most that the call writer can receive. So for this example, let's take a look at stock XYZ. Here it is trading at $100, where you have purchased 100 shares of the underlying stock. It continues to trade at $100 with no expected future movement. So you decide to capture premium on your stock ownership by writing a call at 105 strike with 30 days to expiration. Covered call example 1, out of the money. So over this period of time, the price of the underlying asset rises. And in 30 days, the stock is now trading at $106. You have sold a covered call at 105 for a premium of $5.50. The current stock value is $106 a share, but you will sell your stock at 105 to the contract buyer, netting you a total profit of $11,050 versus somebody who just bought and held the stock for that period of time who can only sell their shares at $10,600. So by capturing that premium in advance, you actually outperform the person who only held the stock through this period of time. Here's another example of writing a covered call in the money. This is something you may do if you have a bearish outlook on the underlying stock in the near term. So say you buy your stock at $100 and it rises up, but some news or fundamental change occurs that means that the stock price will drop in the near future. You write a covered call in the money, predicting this drop and capturing the premium of the upside move that you're now going to lose out on. After 30 days, the option expires with the underlying trading at $98. Covered call, example number 2, in the money. So by doing this, you collect a larger premium because contracts that are in the money demand a higher premium. By collecting this $10.50 premium, your new cost basis on your shares is now $89.50 versus the long buy and hold buyer who has now lost $2 per share on the underlying stock. So now we're going to talk about how to avoid assignment. Sometimes a call writer may not want to lose the underlying shares of the stock and is simply selling calls to generate income while waiting for long-term developments in the company to come to fruition. If the writer fears they may lose the underlying asset, they may buy to close the contract to prevent having their shares called away. This isn't without loss. Doing this will either reduce collected premiums or in some instances will occur positional loss. So we can also hedge covered calls. Like any asset, a covered call can be hedged for a period of time to protect against short-term volatility. If the price of the underlying asset continues below the cost basis, you can roll down the call option to reduce exposure to the price drop and collect additional premiums. If the price declines unexpectedly, a seller may choose to purchase a long put below the strike of the covered call to ensure that you will be able to sell your shares at the long put strike regardless in the drop in price. Alternatively, if the price of the underlying is going to rise unexpectedly, a long call may be purchased at the same strike as the covered call in order to capture any upside movement that may be lost on a covered call only position. So what are the risks of covered calls? We discussed how they are pretty safe, but they do carry some inherent risk, like everything else in the market. A covered call is capital intensive, and the upfront cost is high for a pure option strategy. This is a strategy best suited for those that desire to be long the underlying stock for significant periods of time. For those trading the underlying, a bull put spread offers better returns with lower capital allocation. Stocks with high yield dividends generally have very unattractive options premiums. So if someone is seeking to specifically trade covered calls, they are generally looking for stocks that are more volatile and present a better return on premium based on the risk presented. And covered calls miss out on sudden bullish trends, and in today's volatile markets, this can be missing out on huge upside moves, especially on assets with high implied volatility. So how do you do it? Well, first, you go to your brokerage and you go to sell a call. You choose the strike and ensure that you own 100 shares of the underlying. Then you sell to open one contract at that strike. You will then immediately collect a premium for that sale. You collect the total premium for the contract's value. Remember, options premiums are always price per share, so make sure that you multiply that premium buy the 100 shares. Then you manage your position or simply wait for expiration if the call will expire out of the money. Choose to either roll, hedge, close, or allow it to expire. And that's it for today. Thank you guys so much for tuning in and checking out this video. We will be discussing more option strategies in the future, along with things like technical analysis, value analysis, as we continue to add to this channel. As always, remember to like and subscribe, and thank you so much for all your support.